Great comment here by Antonio. I always look when you comment, then I check, and then if it's interesting, then I look. So Amcor PLC, packaging company, the plastics that we all use. So the shampoos, the this or that. Market cap 18 billion, just merged with Berry Global. Dividend yield 6%. This has to be changed. You'll see later in the analysis at 10, at 4, but still a P ratio of 10. 5-year lows likely. So now unliked. Maybe they will have a recession, but let's discuss the company. So they have acquired this company, and I think a few years ago I looked through the complete MSCI World Small Cap Index, and one of the interesting businesses was Berry Group. Perhaps it was too expensive for me, but now Amcor acquired them at the same level when that business was already interesting to me. So perhaps this is just a decline in plastics, stable business, good dividend yield, good cash flows. So this might look interesting already at this price, and then if it ever reverts to, let's say, a little bit higher, you make 50%, 2x, just like that. So the key news is that they will combine with Berry. Okay, two similar businesses, and 88% of the business is derived from what they say non-cyclical verticals like food, beverage, healthcare, personal care, all things that even if there is a recession, shouldn't be impacted. The sales will not be impacted, but maybe the competition with other providers might be. Something to look at, but usually when you know who is making your plastics for your shampoo, you don't really change that fast. However, something to watch. So they have made a transaction. Amcor will now own 63% of the company, Berry 37%, combined cash flows 3 billion, 1 billion likely expected of capex, 2 billion of free cash flow, which on 18 billion market cap is around 10% free cash flow yield. So they hope to get synergies. This is their business, so Amcor is doing this one, Berry is doing the Heinz, the soap, they are doing this, the yogurt, so Amcor is doing the lid and they are doing this. A lot of customers, a lot of integration globally, 50% North America, 50% the rest of the world, flexibles, containers, closures, things like that, all the things that we unfortunately use on a daily basis. Healthcare, diversified protein, beauty, liquids, food service, pet foods. So certainly something there will also be anti-cyclical. The current model has now been changed, capital expenditure, so they will do more acquisitions, dividends will be lowered a little bit now, so that might also be a shock for current shareholders, and they expect to grow earnings per share through buybacks and etc. Looked a little bit at the last earnings, Transformational, they expect to grow. If they hit that growth targets, the stock will follow. That's how it goes. They will make some asset sales, perhaps lower the debt because they have significant debt on the balance sheet. Their target is to lower this to 2.5 to 3 times EBITDA. So that's something that will take away some cash, but as long as they can do that, it should be good. So now the question is on Synergies, management execution. Of course, if there is a recession, it will struggle, but it should survive. And then you can, if you follow this, you can ride the wave up. Because if I look at long term, this is 25 years of revenues. When they make an acquisition, they grow and then they stabilize, very, very stable things. Net income is cyclical. So there are these ups and downs. So you're buying here now. When the next cycle reverts, you are okay. They like to issue shares when they acquire something. Okay, that's also a strategy. But earnings per share, that's perhaps the concern, hasn't really grown. Okay, this might be something exceptional, but okay, has grown but not that much. So it's a stable, not a lot of growth. And now as they merged with Berry, also the debt went high. So on top of that, Berry Global already had 7.4 billion of that. They acquired some Danish companies 4 or 5 years ago. So that is a concern. and that will have to be managed, and you can watch it. But if that wouldn't be a concern, the stock would already be pretty higher. So this would be the current ratios, P ratio of 10, P ratio of 4. The key concern in the market perhaps is a little bit of overcapacity competition and also the fear of a recession. But this again tells me, okay, everyone is bullish on this AI, but when you look at the real businesses, it doesn't look good. So we might really see a recession. Then I looked a little bit on the conference call. So what type of volume growth is embedded in the forecast? The principle is that volumes are going to be flat, a little bit of synergies here and there. Potential growth investment, buybacks, they have to first lower the leverage down to 2.53, so that will take perhaps a year, 2 years, perhaps even next year, but depending on the growth and the market. But until you wait, when you have a P ratio of 10 and a free cash flow yield of 10, that's 10% yield. And if and when things just get a little bit on the better, you are a 2x. So looks like a stable company, a little bit too much debt, but let's put it on the quadrant. I want to follow it here on YouTube, see how it evolves over time. So I have put it here, let's say 10% free cash flow yield, likely 8% return. There will be some costs with these mergers, etc. And a little bit on the risk side because of potential recessions and that missing that long-term growth and durability. We'll keep watching it as we update the quadrant. We'll see how it evolves over the years. Very interesting business. And I hope you enjoyed this video. If you want to see my portfolios and what I own, check my research platform.